So Tenet Healthcare just decisively beat Q2 2026 consensus across the board. I mean, they've fundamentally outperformed expectations and basically blew past the high end of their own guidance range.
Oh, complete.
Let's just go straight to the numbers. Net operating revenues hit 5.628 billion dollars, which is a really solid 6.8% increase year over year.
Yeah, but the bottom line is where the beat truly, registers.
Right.
Adjusted diluted EPS came in at a massive $6.12,
Wow.
which represents a 52.2% growth rate year over year.
Right.
And net income available to common shareholders, that hit $9.84 per diluted share.
And management made it explicitly clear that this quarter it wasn't just some anomaly, right? The momentum carried directly into their updated outlook.
Exactly. They bumped up their full year 2026 adjusted EBITDA guidance by $295 million at the midpoint. It is. They are now projecting between $4.83 and $5.03 billion. And, on top of that, the adjusted free cash flow outlook saw a substantial raise to $225 million.
So they're targeting between 2.725 and 3.0 to $5 billion now.
Right. And, when a management team raises full-year cash flow by nearly $250 million based on just a single quarter's performance,
yeah,
they are telegraphing to the market that a structural shift has occurred in their earnings power.
Well, and the board's reaction to that cash generation was immediate. Since the earnings report dropped, they authorized a $2 billion increase to their share repurchase program.
Which is just massive.
Right. For retail investors watching capital allocation, that is a glaring signal of internal confidence, especially because it comes right on the heels of the, $1.042 billion. They already spent buying back over 5.5 million shares in just the second quarter alone.
Yeah, it's an aggressive escalation of their capital return strategy.
Yeah.
Year to date, they've repurchased 7.02 million shares for $1.36 billion.
So adding a new $2 billion authorization on top of all that, it just indicates they really believe their equity is still undervalued despite the operational outperformance.
Absolutely. But, as analysts, the critical exercise isn't just reciting the headline beats for you. It's understanding exactly how they are generating the cash to actually fund this.
Right, because the real story for this deep dive is about what happens when a healthcare giant stops trying to be like everything to everyone and deliberately targets the most complex, profitable procedures.
Yes, the focus is everything.
So let's look directly under the hood at segment performance to see how they engineered this. Starting with their primary growth engine, which is the ambulatory care segment, operated through USPI.
USPI is undeniably Tenet's crown jewel at this point.
Oh, for sure.
In the second quarter, the ambulatory segment pulled in $1.388 billion in net operating revenue. That's a 9.3% increase compared to Q2 of 2025.
And that top-line growth translated seamlessly into $542 million in adjusted EBITDA, right? Up 8.8%.
Yep. But most importantly, they held their margins remarkably strong at 39.0%.
Okay, stop there, because if you're looking at this from an investment standpoint, sustaining a 39% margin in healthcare delivery is staggering.
It really is.
You usually only see margins like that in, software or highly specialized biotech. How does an ambulatory care segment actually maintain that level of profitability?
Well, the underlying mechanism of an ambulatory surgery center, or ASC, is fundamentally different from a traditional hospital.
Okay.
They're highly optimized environments designed exclusively for scheduled outpatient procedures. Because USPI focuses so heavily on disciplined expense management, they can tightly control their variable costs.
Right, there's no ER bleeding money at 2 a.m.
Exactly. And if you look at their track record, Tenet has consistently maintained roughly 40% adjusted EBITDA margins in this segment over a really long period.
Wow.
So this quarter's 39.0% simply proves that the operational engine is running exactly as designed, even as they scale the whole platform.
And this segment alone now represents roughly, 25% of their total full year 2026 EBITDA guidance?
Yep, a full quarter of it.
And driving that engine, the data shows same facility system-wide net patient service revenues growing 5.0%. Crucially, they aren't, squeezing out that margin by sacrificing clinical quality.
No, not at all.
They're boasting a 2025 overall patient experience score of 96.7. And in terms of expansion, they added 3 facilities in Q2 to acquired, 1 de novo. But what really catches my eye is that they rolled out 237 new service lines year to date.
See, those 237 new service lines are the vital indicator of organic growth. It shows established expertise in optimization. Like, Tenet isn't just buying facilities to aggregate top-line revenue. They have a dedicated development team focused on delivering strong partnership economic returns.
So they don't just buy and hold.
Right. When they acquire an ASC, they integrate it and immediately begin expanding the types of procedures that facility can handle.
Got it.
And they are currently leveraging this strategy across a massive network. They hold interest in 538 ambulatory surgery centers and 26 surgical hospitals across 37 states.
Okay, I want to challenge the volume data here, though, because there's a very specific nuance in the numbers that stood out to me.
Okay, let's hear it.
Same facility surgical cases were actually down 1.2% in the quarter.
Yes, they were.
But net revenue per case was up 6.3%. I mean, mathematically, if your volume drops but your revenue per case spikes that aggressively, you have completely altered your patient mix.
You have.
So is this shift toward a higher acuity and favorable service mix a sustainable long-term lever? Or are we just looking at like a temporary pricing bump?
Oh, it is absolutely a sustainable structural lever, and it goes to the absolute core of their strategy.
Okay.
Tenet's approach with USPI is not about trying to push maximum patient volume through the doors. It is a deliberate strategic shift in the mix toward more complex, higher reimbursing procedures.
Let's break down the why behind that strategy for a second. Why do certain cases command such higher net revenues?
It comes down to clinical acuity. Look at their 2025 case mix breakdown. Musculoskeletal cases, which we just referred to as MSK, they now make up 30% of their mix.
Okay.
Gastrointestinal or GI cases sit at 42%. By actively expanding their capabilities in these specific complex areas, they drive up the net revenue organically.
Because the procedures themselves are just inherently more expensive.
Yeah. Exactly. Procedures like advanced orthopedics or complex spine surgeries require highly specialized equipment and, top-tier surgical talent. Because the care is more complex, the reimbursement rates from payers are naturally much higher than routine, low-acuity, outpatient procedures.
So they are intentionally passing on lower margin, high volume work to focus their facility time and specialized staff on the absolute most complex cases.
Precisely. They are actively targeting the kinds of cases that require specialized care. And because they couple that strategy with the disciplined expense management we discussed earlier,
right, keeping the costs in check.
They can absorb the costs associated with delivering that higher acuity care without eroding their profitability. That is exactly how you preserve a 39% margin while revenue per case expands by over 6%.
That makes a ton of sense. Now, USPI's 39% margins are phenomenal, but as we noted, ambulatory centers are designed from the ground up to be lean and efficient. The real test of this earnings report is whether Tenet can apply that same high acuity, high margin discipline to their traditional acute care side.
Which is much harder to do.
Way harder. So let's analyze the hospital operations and services segment. We have hospital revenue coming in at $4.240 billion, up 6.0%, generating $762 million in adjusted EBITDA.
And honestly, the margin expansion in the hospital segment is arguably the most impressive metric in the entire report.
Really?
Yeah. We are looking at a 22.3% year-over-year EBITDA growth for this segment alone. Margins expanded from 15.6% in the second quarter of 2025 all the way up to 18.0% this quarter.
I mean, a 240 basis point jump in margin for a legacy hospital segment is just huge.
It is a massive leap.
Yeah.
And it was fueled by a 2.6% growth in adjusted admissions over Q2 2025, combined with a 3.3% increase in same hospital net patient service revenue per adjusted admission.
Okay, before we declare them the absolute kings of hospital efficiency, I do have to point out an accounting tailwind in that EBITDA number.
The Medicaid supplement.
Yeah. The hospital segment recognized a $92 million favorable pre-tax impact from prior year Medicaid supplemental revenues. It's essentially like finding a $92 million check in an old winter coat.
It's a nice coat to have.
It is fantastic for the balance sheet, but it isn't exactly core operational growth driven by this quarter's patient traffic. But even backing that out, the operational leverage driven by commercial employer net patient revenues is what's really lifting that 18% margin, right?
That is exactly the right analytical adjustment to make. The Medicaid supplemental revenue certainly pads the headline number for the quarter. And just for context, Q2 of last year also included a $70 million favorable pre-tax impact from similar prior year Medicaid revenues.
Oh, so the year-over-year comparison isn't entirely skewed then.
Right, it's fairly consistent. But your central point totally stands. The underlying operational leverage is very real, and it is being driven by undeniable strength in the commercial employer demographic.
Let's explain how that operational leverage actually functions in the context of a hospital, because it is very different from an ambulatory center.
Definitely.
Running a hospital is a lot like operating a commercial airliner. Whether you fly with 20 passengers or 200, you still have to pay for the multi-million-dollar plane, the pilot, the crew, and the jet fuel. The fixed costs are astronomical.
That airliner analogy captures the economics perfectly. Hospitals carry massive, massive fixed costs. The physical building, the heavy medical imaging equipment, the minimum staffing required for round-the-clock care management has to pay for all of those, regardless of whether the beds are full or empty.
So when 10 gets a 2.6% increase in adjusted admissions, those extra patients are essentially filling the empty seats on a plane that is already flying. But they aren't just filling seats with economy passengers. By focusing on higher acuity cases, just like they're doing in the ambulatory centers, they are effectively upgrading those incremental passengers to first-class tickets.
Yes. And when you layer a favorable commercial payer mix on top of that, the operational leverage kicks in aggressively.
Right.
Because commercial employer-sponsored insurance traditionally reimburses at a much higher and more profitable rate than government payers.
Yeah.
So you have more patients requiring higher reimbursing complex care, funded by the best-paying insurance tier, all flowing through a fixed-cost infrastructure.
It's the perfect storm.
It really is. The fixed costs get absorbed far more efficiently, allowing a disproportionate amount of that incremental revenue to just flow straight down to the EBITDA line.
That perfectly illustrates how a 6% revenue increase can transform into a 22.3% EBITDA increase. It is entirely about pushing the right mix of patients through a fixed-cost infrastructure. You can actually see this strategy playing out in their outpatient stats for the hospitals as well. Outpatient visits were actually down 1.5% year-to-date, and ER visits were down 0.7%.
So they're not just chasing pure volume.
Exactly. They are actively managing that airliner. They are running slightly fewer total visits in certain areas, but the ones they do treat are vastly more profitable.
It is a highly disciplined approach to capacity management.
Okay, so we have the ambulatory engine humming at 39% margins, and the hospital segment expanding to 18% margins through serious operational leverage.
Right.
Let's zoom out to the consolidated profitability, the health of the balance sheet, and, the macro headwinds management is actually flagging.
So on a consolidated basis, combining both segments, the adjusted EBITDA margin hit a stellar 23.2%.
Wow.
But what is truly compelling for retail investors is how they are utilizing the massive cash generated by those margins.
To pay down debt?
Yes. The balance sheet is rapidly deleveraging. Their net debt to adjusted EBITDA ratio has dropped down to 2.33 times at the end of June.
Contextualize that 2.33 times figure for us, because hospital operators have historically carried heavy debt loads since the business is incredibly capital intensive. Where was Tenet previously?
Well, in 2025, that ratio was 2.85 times.
Okay.
In 2024, it was 3.24 times. And if you look all the way back to 2017, they were levered up to 6.95 times EBITDA.
Oh my God. Going from roughly 7 times levered down to 2.33 times, that completely changes the risk profile of the equity.
It is a total structural transformation of their balance sheet.
Yeah.
And this multi-year reduction in leverage has been achieved through persistent operational improvements and strategic hospital sales.
Right.
Today, they're sitting on $2.17 billion in cash on hand, alongside a $1.9 billion unused line of credit.
That rapid deleveraging opens up a massive amount of optionality for capital deployment, which honestly entirely explains that $2 billion buyback authorization we talked about at the top.
Exactly.
When your debt is that manageable, you can aggressively return capital to shareholders rather than just servicing interest payments.
Right.
It ties perfectly into what CEO Dr. Sam Sutaria noted in the earnings release. He emphasized how Tenet is actively navigating industry dynamics through, quote, excellent operational execution, investments in innovation, and a continued focus on higher acuity services to sustain growth, margins, and significant free cash flow.
It's playing out exactly to plan.
But as analysts, we can't just read the victory lap. There is a specific notable risk in the report. It's not entirely smooth sailing.
No, it isn't. While the internal execution is clearly working, management was very transparent about flagging a specific macroeconomic headwind.
Yeah.
Throughout the report, they repeatedly cited unfavorable payer mix due to lower exchange admissions. This was a persistent theme, creating a drag against both their hospital revenues and their adjusted EBITDA.
I see that risk repeatedly highlighted in the notes, but I want to push back on how heavily we should really weigh it. I mean, they are executing on this high acuity strategy brilliantly across both segments. How much of a drag is this unfavorable payer mix on future margins, really?
Right.
Like, if exchange admissions keep dropping, doesn't the sheer strength in their commercial employer volumes just offset it entirely?
I mean, if we connect this to the bigger picture, it is the classic tension in healthcare services. Exchange admissions, meaning patients coming through the Affordable Care Act marketplaces, they typically carry different, often lower margin profiles compared to commercial employer-sponsored insurance.
I care.
And Tenet is currently fighting a tangible volume decline in those exchange admissions.
But wait, if exchange admissions have lower margins anyway, losing some of that volume while gaining commercial volume sounds like it would actually help their margin percentage, even if it creates a slight drag on absolute revenue.
In isolation, yes. However, what we are seeing this quarter is that the absolute strength of the commercial employer volumes, combined with the deliberate pivot to those complex MSK and GI cases, is more than offsetting the drag right now.
Right now.
But the risk management is highlighting is a scenario where the commercial employer market softens, perhaps due to a broader macroeconomic downturn, while exchange admissions remain depressed. If both of those levers pull in the wrong direction simultaneously, that 23.2% consolidated margin floor could face real pressure.
I understand. So the risk isn't just the drop in exchange admissions. The risk is their reliance on commercial employer strength to cover that drop.
Exactly.
As long as the commercial employer side holds up, they can absorb the exchange admission weakness and still print these strong EBITDA beats. But if the labor market cracks, their best-paying demographic shrinks.
Exactly. It's a concentration risk. But, their guidance raise strongly suggests they expect the commercial strength and their internal operational execution to continue overpowering those exchange headwinds through the rest of 2026.
So let's synthesize the core takeaways for you from this deep dive. Tenet Healthcare is successfully executing a high-margin, high-acuity strategy across both USPI and its acute care hospitals.
Definitely.
By deliberately prioritizing complex cases, they are maximizing their fixed cost infrastructure. And the result is massive cash generation, $1.42 billion in adjusted free cash flow year to date.
Unbelievable numbers.
They are aggressively returning that cash to shareholders with a newly authorized $2 billion buyback, while simultaneously driving balance sheet leverage down to a very comfortable 2.33 times EBITDA.
It is honestly a textbook example of utilizing operational leverage and strict capital discipline. But I will leave you with a final macroeconomic question to ponder.
All right, let's hear it.
If Tenet can expand their consolidated margins to 23.2% while actively fighting unfavorable payer mix headwinds from lower exchange admissions, what happens to their free cash flow profile if macroeconomic conditions shift and those exchange admissions actually rebound alongside their commercial strength?
Oh, wow.
Are retail investors looking at a permanent structural upgrade to Tenet's profitability floor?
That is a question that completely changes how you view their long-term valuation. I mean, if their healthcare delivery engine is already operating this efficiently while fighting a demographic headwind, a reversal of that headwind could mean explosive upside.
Exactly.
We will leave you to mull that one over. Make sure to follow the show for daily, no-fluff earnings coverage just like this.